Imagine a business that, well, hasn't changed its core financial playbook in its entire corporate history.
Right, just decades of extreme caution.
Exactly. Carefully managing risk, playing the exact same game as everyone else in town. And then, seemingly overnight, they declare uh, this structural, permanent commitment to send a portion of their cash back to shareholders every single quarter.
It's a huge shift.
It really is. Like, why would a regional bank suddenly start acting like a Wall Street dividend darling right in the middle of a highly volatile economy?
Yeah, that's the million-dollar question.
Welcome to the Deep Dive. Today, we are taking you inside a truly fascinating case study in business transformation and, frankly, financial resilience. We're unpacking the Q1 2026 earnings presentation and press release from Texas Capital Bancshares, Inc. You probably know them under the ticker TCBI.
And for you listening, whether you're, keeping tabs on the financial sector, prepping for a corporate strategy meeting, or just fascinated by how traditional companies fundamentally reinvent their operating models, this really is a masterclass. The regional banking sector has seen a tremendous amount of volatility recently.
Okay.
We were talking shifting deposit behaviors, aggressive moves in interest rates.
You said overall economic uncertainty, right?
Exactly, testing the entire industry.
Yeah.
Yet, what we are looking at today with TCBI is a Q1 2026 performance that isn't just about surviving that volatility. It's about leveraging a massive strategic shift to fundamentally thrive in it.
So the mission today is to figure out the mechanics of how they pulled it off. Because we are looking at a regional bank that achieved a massive 63% year-over-year jump in net income.
Which is wild.
It is. And before we look at the plumbing of how they generated that money, we really have to look at what they are doing with it. Because their capital return strategy sets the stage for everything else.
It tells you everything about management's confidence.
Right. So for the first quarter of 2026, net income available to common stockholders hit $69.5 million.
Wow.
Yeah. And adjusted earnings per share grew 72% year over year to $1.58.
That's a huge jump.
Their tangible book value per share hit an all-time high of $75.67, which is up 11% from the previous year. And then, here's the headline grabber, the board declared a first-ever quarterly cash dividend of $0.20 per common share.
What's fascinating here is that the focus on that dividend is just so critical. A dividend isn't just a one-time pat on the back.
Right, it's not a bonus.
Exactly. If a company simply has a great quarter due to a one-off event, they might buy back some stock or perhaps issue a special one-time dividend. But initiating a regular recurring quarterly cash dividend, that is a structural long-term commitment.
Because you can't really take it back without a huge penalty from the market.
Precisely. It signals to the market, to investors, and to clients that this bank's earnings generation has reached a whole new tier of sustainability. They're basically broadcasting to the world that they generate enough excess capital consistently that they can permanently afford to send a chunk of it out the door every 3 months.
Regardless of the macroeconomic weather. Okay, let's unpack this for a second, though. Because, like in the tech sector, for example, initiating a dividend usually triggers a panic.
Oh, sure.
Investors see it as a white flag, like a sign that the company has run out of innovative ways to use its cash, so they just throw it back to the shareholders. Why shouldn't we view TCBI's new dividend as a sign of stagnation?
That's a fair question.
Right. If they have all this cash, why aren't they deploying it to grow the business?
Well, because the mechanics of growth in the financial sector operate under completely different constraints than, say, a software company. Banks are highly regulated entities that require immense amounts of capital to grow their loan books.
Oh, right. You can't just lend infinitely.
You really can't. You need a bedrock of capital to back those loans. If a bank truly lacked growth opportunities, you'd see their loan balances stagnating or shrinking. But as we'll see as we dig deeper into these Q1 numbers, TCBI is growing its loans by billions of dollars.
So they are growing and paying the dividend.
Right. The dividend here is actually a massive flex. It shows that their return on equity has become so strong and their profit engine so efficient that they can easily fund robust double-digit loan growth and still have enough excess cash left over to reward shareholders.
So initiating a dividend in this context is a bit like moving from dating to getting married.
That is a great way to put it.
You don't make that kind of recurring public commitment unless you have rigorously stress-tested the relationship and are absolutely certain about your long-term stability.
Yeah, and the volatility of the past few years tested the balance sheets of every mid-sized bank in the country. For TCBI's management and board to make this structural commitment right now, it means their internal projections are showing an incredibly durable earnings profile.
They aren't hoping they can pay this 20 cents next quarter.
They know they can.
But keeping that dividend flowing requires, like, a river of cash, and relying solely on traditional lending to get it is a dangerous game when interest rates are bouncing around.
Oh, absolutely.
Which brings us to the actual mechanism driving this 63% profit jump. If you comb through the earnings presentation, the answer reveals a dramatic strategic shift away from basic lending.
The transformation taking place under the hood here is profound because, the traditional banking model is heavily reliant on net interest margin.
Right, the spread.
Yeah, the spread between the interest a bank earns on the commercial loans it issues and the interest it has to pay out on the deposits it holds for its customers. It's the bread and butter of regional banking.
But it's highly vulnerable to the Fed, right?
Entirely. It is highly vulnerable to what the Federal Reserve does with interest rates. If the cost of deposits rises faster than the yield on your loans, your margin gets instantly squeezed.
So how do you escape that trap? Well, you diversify. If you look at TCBI's fee income from what they categorize as their areas of focus, it increased 59% year over year to a record $58.8 million.
That is a massive jump for fee income.
Huge. And the heavy lifter here was investment banking and trading, which surged an astonishing 89% to a record $42.3 million.
Unbelievable.
Plus, wealth management fees also hit a record $4.4 million, and that was supported by a 16% growth in assets under management.
Oh, and their treasury product fees increased by 14%.
If we pull back and look at the architecture of the firm, TCBI is evolving from a traditional regional lender into a full-service financial services platform.
Right.
Investment banking, wealth management, treasury services, these are pure fee-generating businesses. They fundamentally alter the risk profile of the company.
Because you aren't risking your own money.
Exactly. In traditional lending, you're putting your own balance sheet on the line. You lend out $10 million, and you bear the risk of that $10 million not coming back. But in investment banking and wealth management, you are getting paid for your expertise.
You're getting paid to give advice.
Yes. You are getting paid for structuring a merger, for executing trades, for advising a client on how to manage their excess cash. It's basically like a restaurant deciding to change its business model. The traditional loans are the dining room. They require massive overhead. You have to buy the ingredients, pay the wait staff, and take all the upfront financial risk, hoping enough people show up to cover your costs.
That's a perfect analogy.
But the new investment banking and wealth management wing is like selling the restaurant's famous recipe book. It's pure fee income. It requires almost zero capital risk, but the margins are incredibly high, and it scales effortlessly.
And that recipe book revenue protects the dining room. In the earnings call, CEO Rob C. Holmes specifically pointed to this diversification of our revenue base. He highlighted that these fee-generating businesses are contributing a meaningfully larger share of total revenue.
Which gives them that durability.
Exactly. It directly reinforces the durability of the operating model. If the economic environment shifts, or if commercial clients pause their borrowing because interest rates are too high, those clients still need financial services.
They still have to run their businesses.
Right. They still need advice on acquiring competitors, they still need to hedge their interest rate exposure, and they still need treasury management. Previously, a regional bank would lose that client to a massive Wall Street firm for those specific needs.
But now TCBI captures that high-margin revenue directly.
Exactly.
They are essentially building a walled garden where the client never has to leave. But, even with the recipe book flying off the shelves, you can't let the dining room catch fire.
No, absolutely not.
The core business of taking deposits and making loans still has to function at a high level. So let's shift our focus from the surging fee revenue to the traditional engine of the bank. Specifically, their commercial loans, deposit costs, and a very interesting metric around their mortgage finance division.
Because despite the explosive growth in investment banking, TCBI's balance sheet is still driven by traditional banking operations. And the momentum there is substantial.
The raw output of that engine is genuinely impressive. Commercial loan balances increased by $1.2 billion. That's a 10% year-over-year increase.
Which is strong in this environment.
Very. Their total loans held for investment, or LHI, grew by $2.8 billion, up 13% year over year, to reach $25.2 billion.
And the most critical part of that equation,
Right, the deposit costs.
yes, while they are lending significantly more money out, the average cost of their interest-bearing deposits actually declined by 15 basis points, down to 3.32%.
Which just doesn't happen often. Growing loan volumes by 13% while simultaneously driving down the cost of the deposits used to fund those loans, that's essentially the holy grail of bank management.
It really is. But if you want to understand the true operational discipline driving these numbers, you have to look at their mortgage finance self-funding ratio.
Yes, okay, that metric was front and center in the materials. The ratio improved dramatically down to 80% compared to a bloated 113% back in Q1 2025.
That is a massive shift.
A huge swing. But hold on, let's do plain English for a second. Walk me through the actual plumbing of how TCBI achieved that. Like, what is a self-funding ratio? Are they just forcing these mortgage companies to park more non-interest-bearing cash with them to get the loans?
That is exactly what they're doing, and the plumbing behind it is brilliant. So mortgage finance in this context means TCBI is providing short-term funding lines to independent mortgage companies.
Okay.
When a mortgage company originates a loan for a family buying a house, it takes a few weeks to package that individual loan and sell it off into the secondary market to investors. During that waiting period, the mortgage company needs massive amounts of cash to fund the origination.
And TCBI provides that cash.
TCBI provides that cash.
So TCBI is the liquidity bridge. But TCBI has to get that cash from somewhere to lend it out.
And that funding side is where the invisible battle is actually won. When that self-funding ratio was sitting at 113% a year ago, it meant TCBI was lending out significantly more money to these mortgage companies than those companies were keeping in deposits at TCBI.
Oh, I see.
To fund that 13% gap, TCBI was forced to go out into the open market and borrow expensive wholesale money or pay really high interest rates to attract temporary deposits.
They were essentially forced to buy extremely expensive money just to lend it out again, which crushes the profit margin on the loan.
Exactly. By driving that ratio down to 80%, TCBI fundamentally changed the terms of the relationship. They went to these mortgage clients and demanded that they bring over their actual operating deposits.
The cash they use for payroll, for escrow, daily operations.
Right, and these are generally non-interest-bearing checking accounts. So now if TCBI lends a mortgage company $100, that same company is keeping at least $80 in free cash sitting in a TCBI account.
Wow.
And TCBI uses that free cash to fund the loan.
That is an incredible lever to pull because it dramatically lowers TCBI's total cost of funds, giving them a massive competitive advantage when interest rates are volatile.
It proves they aren't just blindly chasing loan growth for the sake of looking bigger.
Right. They are demanding profitable, holistically well-funded relationships from their clients.
It's a prime example of choosing margin over sheer volume. But, anytime a bank is aggressively expanding its loan book, and remember, they added $2.8 billion in total loans held for investment.
Huge number.
The immediate question has to be about the risk they are taking on to achieve that growth.
You're pushing $25.2 billion out the door, you're changing the terms on your mortgage clients, and you're expanding the commercial loan book by double digits. Usually when a bank grows that aggressively, they are forced to lower their underwriting standards just to find new borrowers.
Right, they scrape the bottom of the barrel.
Exactly. And aggressive growth is only profitable if the businesses actually pay the money back. So how is TCBI playing defense?
Credit quality is the foundation that allows everything else, the dividend, the share buybacks, the investment banking expansion to exist. If the loans start rotting from the inside, the earnings vanish instantly.
Let's look at the actual damage then. Quarterly net charge-offs, which, for you listening, is the debt the bank has formally decided is uncollectible and written off, came in at $17.4 million. That represents roughly 30 basis points of their average loans held for investment. They also set aside a provision for credit losses of $16 million for the quarter.
But out of all the numbers in the earnings release, here's the statistic that completely stops you in your tracks.
I'll hear it.
Their criticized loans actually declined by $112 million. That is a 15% drop year over year.
Wait, really?
Yes. And that right there is the true aha moment of this entire earnings report. Expanding a loan portfolio by billions of dollars while simultaneously shrinking the pool of potentially risky loans by 15%. That is an absolute masterclass in underwriting discipline.
Walk me through the mechanism of how a bank actually achieves that. Because intuitively, if you write more loans, you should have more problem loans. What exactly is a criticized loan, and how do you shed $112 million of them during an expansion phase?
So think of a criticized loan as a bank's internal early warning radar.
Yep.
The borrower hasn't necessarily missed a payment yet, and they might not even be in default. But the bank's internal risk managers have flagged a potential weakness. Maybe the company's industry is facing headwinds, or their cash flow dipped slightly last quarter.
So the bank puts them on a watch list.
Yeah, exactly. To see that watch list shrink by 15% while the overall loan book grows by 13% means two things are happening simultaneously. First, the new loans they are originating are of extremely high premium quality.
And second,
Second, they are actively and successfully managing their older, weaker relationships out of the bank. They are telling riskier clients to go find funding somewhere else.
so what does this all mean? I want to challenge the overall rosy picture for a second, though.
Okay, go for it.
We just noted that net charge-offs were $17.4 million for the quarter. Non-performing assets also ticked up slightly to 50 basis points of total assets. So for you listening, if you are looking at a balance sheet and see $17.4 million in actual realized burned capital, should you view that as a red flag regarding their underwriting?
Honestly, no. When you are managing a $25.2 billion commercial loan portfolio, a 0% loss rate is a mathematical impossibility.
Right, you're going to lose something.
Exactly. A 30 basis point charge-off rate is entirely manageable, historically quite low, and frankly just the normal cost of doing business at this massive scale. The real metric you have to look at is the shock absorber the bank has built to handle those inevitable bumps in the road.
You're talking about the allowance for credit losses.
Yes. Their total allowance for credit losses, or ACL, to total loans sits at 1.32%.
What does that mean in real dollars?
That means they have hundreds of millions of dollars sitting in reserve, already accounted for as an expense, explicitly waiting to absorb any future losses. They aren't going to be caught off guard. And if you zoom out to their broader capital strength, it paints an even more resilient picture.
Yeah, if you look at their Common Equity Tier 1, which is essentially the strictest regulatory measure of a bank's core financial strength and its ability to absorb a massive economic shock, they are sitting at a 12.0% CET1 ratio.
Which is vastly above the regulatory minimums. Regulators generally want to see CET1 sitting comfortably above 7 or 8%, depending on the specific risk profile of the institution.
So sitting at 12.0% is huge.
Sitting at 12.0% means TCBI has constructed a fortress balance sheet. They have so much excess capital piled up that they didn't just initiate that historic dividend. In Q1, the firm also repurchased 770,000 of its own shares for $75 million.
Oh, wow. And they bought those shares at roughly 127% of the prior month's tangible book value?
Yeah.
I mean, you don't buy back your own stock at a premium to book value to the tune of $75 million unless management and the board believe the market is severely underpricing their future earnings power.
It is playing extreme offense with your own defense.
That's a great way to put it.
They are firing on all cylinders. They are playing offense by capturing high-margin fee revenue through their new investment banking and wealth management platforms. They are optimizing the plumbing of their traditional engine by forcing better deposit terms through that self-funding ratio we talked about. And they are playing a remarkably tight game of defense by shrinking their criticized loans and maintaining that 12.0% CET1 fortress.
This has been an incredibly revealing look under the hood of corporate reinvention. To summarize the journey we've just taken, for you listening, TCBI's Q1 2026 demonstrates exactly how a company escapes the gravitational pull of its own history.
Absolutely.
They proved that by building out a full-service platform, adding that high-margin recipe book of investment banking, trading, and wealth management to their traditional lending operations, a regional firm can fundamentally alter its trajectory.
It's not just theory, it's in the numbers.
Exactly. They achieved record tangible book value, aggressively bought back their own stock, and reached the ultimate milestone of maturity by issuing their first-ever quarterly cash dividend. They navigated the muddy, volatile waters of the recent banking environment by just entirely changing the boat they were sailing in.
This raises a highly provocative question, though.
Oh.
Yeah, and it's something I really want you listening to mull over as you look at the broader financial landscape. If a regional bank like TCBI achieved this level of record-breaking stability and a 63% profit jump by successfully transforming into a diversified financial platform, does this mean the traditional regional bank model is dead?
Wow, that is a fascinating implication. Like, if relying strictly on net interest margin is simply too volatile in the modern economy, is this the only way forward?
Will every successful mid-sized bank eventually be forced to become a mini Wall Street firm to survive the future of finance?
That's a serious question.
If you can't offer investment banking, treasury solutions, and wealth management alongside your commercial loans, you might be left holding all the balance sheet risk while someone else captures all the premium fees.
Right.
We might literally be watching the definitive blueprint for the entire next generation of regional banking being written right here in these Q1 numbers.
It really makes you wonder if the days of the simple, single stream local commercial bank are numbered. Well, thank you for joining us on this deep dive. Keep questioning the mechanics behind the numbers. And remember, whether you're running a regional bank or a local restaurant, sometimes you have to start selling the recipe book to build a fortress. We'll catch you next time.